Welcome to Money Matters TV. My name is Paul Mitchell. I'm a commercial banker, and I'm also the Chief Credit Officer of Upland Business Credit. I am the host for your show, and I'm joined by my co-host, David Emery. He's with the Marshall Financial Group. David, welcome to the show.
Oh, well, thank you, Paul. It's great to be here. And before we start the show, I just wanted to read our disclosure agreement briefly.
Certainly.
That'd be great. So again, my name is Dave Emery with the Marshall Financial Group. Marshall Financial Group is an SEC registered investment advisor with its principal place of business in Doylestown, Pennsylvania. For additional information about Marshall, please refer to our website, or please request a disclosure brochure as set forth on Form ADV using our website, www.marshallfinancial.com, or refer to the Investment Advisor Public Disclosure website, which is www.advisorinfo.sec.gov. Any information on today's show is not intended for personal advice. So thank you there. It's good seeing you.
Well, Dave, thanks for the information also, but tell us a little bit about what you do and why you have that disclosure. And maybe you can tell us a little bit what you hear from some of your clients too.
Yeah, sure. So, we're a financial planning firm in Doylestown, Pennsylvania. And some of the things that I'm recently hearing on our clients' minds it's a number of things. One is everything from college affordability. College has become so expensive these days, and anywhere from 45 to I think up to $70-some thousand a year, just crazy. Wow. So college affordability is one area. Downsizing, job downsizing is another area, and then lastly is helping elderly parents. Both financially and helping them as they age. And really, a lot of this stuff that's going on in their lives can equate to one of the big concerns is being able to retire in the future. So that's some of the areas that we're seeing right now.
Well, I like the one. Let's touch a little bit about the downsizing and all, because I've been a commercial banker and a non-banker for decades. And a lot of the entrepreneurial, if not most of the entrepreneurial companies, well, most of them do have to come from people that have experience, establish a company. And a lot of them have come from corporate downsizing. So they're fed up with the corporate bureaucracy, the whatever it is that, and one of the whatever it is they lost your job and your corporate after 25 years, decided to start their own business. So let's talk a little bit about that. Tell me about the downsizing. Saying last 5-10 years, what trends have you seen?
Well, absolutely. So I see that people a lot of times, I guess in 15, 20 years ago regarding retirement, there's a term called cliff retirement, which basically means that you work for a company for 30 years and then you had a date up in some date and time, and at that time you retired and that was it. It's kind of like a cliff. Whereas nowadays I'm seeing more people transition to the next phase in life. It may not be the job that they were doing, for the first career, but it's more transitioning to something they want to do. And really, a lot of the kind of like you said, when you're employed, when you have a job, it gives you a lot of aspects of your life. It gives you financial. There's a financial component to it. There's a social component. There's a sense of meaning and belonging. There's a social component to it. So when you retire, a lot of those things, if you don't think through it, a lot of times that's stuff that needs to be, addressed. And to your point about downsizing, a lot of times people are using that second phase in life to help fulfill some of those areas that they may not have anticipated to when they were thinking about retiring or thinking about when they were downsized. So
we just interviewed a guest on an earlier show. It was just that along those lines. I've been a mortgage banker and got into an idea of helping restaurant chefs sell their recipes. A little bit different.
Great. Yeah. So tell me a little bit about commercial lending. What are you seeing these days?
Yeah. Well, with the pandemic situation and the PPP, the payroll protection plan monies, billions, hundreds of billions of dollars and that type of thing. I've been working with one of my colleagues in helping companies get those loans, and it's been absolutely brutal.
I bet.
I mean, the money is pretty much gone. I mean, it's a big country and stuff, and tens of thousands, hundreds of thousands, millions of companies applied, and millions of got their loans and all. Many other millions have not, for a whole variety of reasons. It's been just a murderous process. And one of the issues I've sort of come across is that the small business loan program is roughly $350 billion.
Wow.
The total stimulus program, and it's pretty much done, I think, it's $3 trillion. Okay? It's a lot of money.
That is a
What is
lot.
that? Well, how much is that? Well, I looked it up. The GNP of the United States of America last year was $21 trillion. 21 trillion. Our stimulus program was 3 trillion. 1/7 of our annual GNP was pushed into the economy to stimulate it over the past 2 months or so. I don't understand that, because the GNP of the country during that 2.5 months was roughly 1/7 was roughly $3 trillion. The country did not come to a complete standstill. It wasn't one apple sold, wasn't 1 gallon of gasoline sold during that time period.
Yeah.
Where did the $3 trillion go? To me, our economy should be booming, because we have 6 times more money being pumped into the economy than would have been under normal circumstances.
Right.
I just don't understand.
I know.
You get a grasp on that?
Yeah. Well, I'm not an economist, so
Everybody put the money in their pocket in the savings account for the next 12 years? Not me.
yeah, I hear you. Yeah.
So
yeah.
the numbers are so huge and so statistically oriented, whether it's those dollars or whether it's a coronavirus positive tests or whatever.
Yeah.
My head's spinning. And in terms of the small business activity, I mean, that protection plan is to keep businesses in business so they keep their employees.
Right.
You have to justify in 8 weeks that they kept their employees by copies of their paychecks, all that type of stuff.
Yeah.
And another thing I ran across is the mergers and acquisition activity. Businesses, people buying and selling businesses, come to complete stall, because how could you possibly value a business if a lot of its business has gone away, and maybe more of it will go away in the next couple of months?
So you got a question for me?
Yes, I do.
All right.
Well, from one of our viewers, Thomas Long of Philadelphia, asks, how has the COVID-19 pandemic impacted retirement accounts?
Yeah. Wow. So kind of like you said, kind of alluded to earlier, with the whole uncertainty of the market due to the virus has just certainly caused the accounts to adjust, and not in a favorable way. So I mean, that's the harsh reality. I guess if you want to look at some of the silver lining, part of that package you talked about, the $2 trillion package that the Congress recently passed.
Sure.
There's been some silver linings to it, from the standpoint that, assuming that you, first of all, if you've been impacted by the coronavirus, this is an important detail. Impacted means you've had it, either your family's had it, or your employment has been affected by that. If you've been affected by that, and again, this is something that viewers should consult their financial advisor and the tax people to confirm this. But if you've been impacted by the virus, you can take money out of your IRAs penalty free.
Wow.
You don't have to pay it back, pay tax on that for 3 years. So that's something that's changed. So that's one area. And then the other area that's was part of this legislation had to do with taking loans out against your retirement accounts too. And you are able, again, if you've been impacted by the coronavirus, to take money out of your IRAs, your retirement accounts. Don't have to start paying them back this year, but you have 5 years to pay it back. So those are a couple of areas that I guess is a little bit of a silver lining to this, helping families, financially through this.
Yep.
And then the other last area is you don't have to be impacted by the coronavirus for this, but Congress has basically waived having people taking their required minimum distribution this year. because of what's happened with the market. So
Yeah.
again, all these areas should be reviewed with your financial advisor and your tax advisor. But some things to look into that could help.
Yep, that's good advice with it. Speaking to an expert, and because you're going to be required, if you're going to get these benefits, you are going to have to document these facts. You got the coronavirus. Somebody else did. You're impacted. You got to document. So speak to your expert advisor. What kind of documentation you're going to need, because it's going to be some work. Let me tell you.
Yep.
Interesting. Well, that's an excellent answer to the question from our viewer. So if other viewers would like to have their questions answered, here's how you can do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
I'd like to introduce to our audience David DeWitt. He's with DeWitt Capital Management. He has I think a close relationship to the company here. So David, tell us a little bit about what DeWitt Capital Management is.
DeWitt Capital Management is a registered investment advisor. We've specialized in the past in local Philadelphia area and regional companies. Also specialized in the energy sector, which has been a little tough lately.
Yeah.
And
We'll come back.
And thank you.
I think
we've been focused on leveraging technology to enhance returns from various, let's say, ETFs or stock portfolios such as the S&P 500 or S&P 100.
So what do you mean by that? I hear those words ETF. I know electronic transfer funds or something.
Yeah, well,
S&P, but
let's say if you were an investor in the S&P 500, and Jack Bogle at Vanguard would tell you, you just put your money in the S&P 500 and forget it, and that's the best
index fund. Yeah.
What we're saying is by using technology and some software that we've been spending years developing, you can actually reshuffle the deck of the components of the S&P 500 on a yearly basis based on price movement, which is sometimes a forecaster or some way that reveals what's going on with the company. By reshuffling the deck and using back testing, what they call out of sample back testing, which means you can't change the rules once you set up the rule for how you're going to reshuffle the deck. That's the rule that's in place from then going forward. And what we've discovered, and if you're a bit like me, you'd say, I don't believe this is true or that it's even possible, but it is possible that you can exceed the returns from the S&P 500 or S&P 100 or any ETF you choose to dissect, decrease the risk and increase the overall return on a year basis.
And you're not doing individual stock picking.
No, you can do individual stock picking. You can take a look at the S&P 100 and using the technology on a yearly basis, reshuffle the deck so that the next year going in, you're picking the ones that are most likely to outperform and also less likely to be volatile. And so this is a relatively new part of DeWitt Capital Management. And, it was brought to our firm by a friend of mine I've been working with for a number of years. And it's something that I think people, again, like it sounds like it's alchemy, turning lead into gold, but it actually works.
Well, do you have to do high-speed trading? So you have to move your office to 100 feet of the New York Stock Exchange and all that type of stuff?
No, there's no high-speed trading. There's one trade. The trades are done once a year, and there's no high-speed trading. This is very low-speed trading. This is as slow as you can go.
I like that.
So the rules are kind of, so what you kind of have guidelines then, I guess. Is that what you mean on parameters on when you would buy and sell?
The only time you would buy and sell would be on a 1-year anniversary, or at the most, 6-month anniversary, and the buys and sells would be dependent on the price action of the stocks within the index. So if it was the S&P 500, you'd examine all 500 stocks within the S&P 500, and then we would select 20, 25, maybe at the most 30 going forward, but they would be diversified into the various sectors of the S&P. So you wouldn't be in only one sector. You'd have to be diversified amongst like energy and capital goods and consumer goods and retail and real estate, et cetera, et cetera, et cetera. So you're going to be diversified, but you're going less stocks, and it's been shown outperform the S&P 500 or S&P 100, or you could even pick an index or an ETF that you like and dissect the components of that and run the same rules or maybe change the rules. And the idea is to soften the performance, try to reduce the amount of the downside. Not going to get all the upside in the up years, but reducing the drawdown, your overall performance should be better than the index itself.
Interesting. So
we have this very famous investor, Warren Buffett. So what does he do? How does that compare with what you're talking about?
Ours is based on I'm almost a chartered market technician, CMT. I've passed 2 of the 3 levels for that. That's technical analysis. And basically, technical analysis is a way of looking at a stock, reflecting the performance of the actual company in a way that maybe you can't see in a fundamental report or a research report or something that you've heard. The stock price performance is sometimes reflective of things that you cannot see. So what we're doing is it's basically sort of enhanced technical analysis. And the selections are made based on the price action of the stocks within the index. And we're looking for smoothing out the performance and looking for the least volatile companies within the index so that when the market does tank, you go down quite as much.
Yeah. So, and it's for, I'll say, a longer term perspective as opposed to, day trading, when you're looking technical analysis, day trading, stock behavior, boom, 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 boom. Doing this, every 3 times a day or something.
Absolutely not. This is once a year we make a transaction.
Okay.
To change the components, because if you look at the S&P 500, the largest companies it's market cap weighted. If you buy the index, you're going to be buying the big companies in that index. Or the S&P 100, you're going to get Amazon and Facebook and Microsoft, and you're going to get them year after year after year. But there might be companies doing better than others, and there might be companies that are trading better than others. And we're not going to look at them based on the size of the company or its place in the index. We're going to look at them all equally and determine from that which companies are going to be in the portfolio for the upcoming year.
So how much experience have you seen in, volatile markets in the last 10 years, 12 years, or?
If you look back?
Yeah, in terms of what the rules that you now have, they're based upon what happened in the last 12 years or 6 years?
It looks back about 4 or 5 years.
Okay.
It's going to do a look back about 4 or 5 years and look at the trends and other statistical analysis and make the decision based on what was that goes back 4 or 5 years, and then that's based on that we'll determine which are the components of the S&P 500 or 100 that we're going to use for the next 12 months.
Okay. Is there any you use any margin component on this or not at all?
No margin. This is
great.
This is pretty plain Jane. This is pretty, this is pretty boring when it comes down to, segment of trading or whatever. It's not like that at all. This is more like you set it for the year, then go to sleep, and set it again the next year and go to sleep.
And you tell your clients that you're sleeping 300 days a year?
Now you caught me. No. Well, again, this is a capital management. You got to remember, we're still invested in the energy sector. So this is
pretty exciting.
3 components. So believe me, Mike, we are awake, and we're dealing, looking at whatever's going on, which 90% I can't understand anyway. And how did we get negative oil prices? That was pretty crazy.
We have negative interest rates too, I mean, what the heck?
Wish I could have, they were paying you $37 a barrel to take oil off somebody's hands. I wish,
If you're a big swimming pool, you make a lot of money.
I could have sold, they could have given the oil for $37 a barrel, and I could have sold it in June for 30. That wasn't even in the stimulus plan.
Genius.
Right. So what you're doing with volatile markets, how's that? You talk a little bit about that.
Well, the thought is that this whole system is designed to reduce the volatility of your portfolio. So volatile markets are when the strategy actually outperforms the most. So if somebody's hesitating, should I go into the market? I mean, I've been scratching my head a lot lately with the market. Again, I know this broadcast is not timed for any particular time when it's actually sent to viewers, but when the market's going up, but you see unemployment at 16, 17 states worth of people are unemployed, and I know, I think Paul, you were mentioning just the size of the stimulus.
Yes.
But it's such a mishmash, and just don't know how to forecast anything at this point.
Yeah.
I don't know how.
A lot of ifs.
A lot of ifs. Well, there's always a lot of ifs with the market, unless it's just steadily going up year after year, and you don't think about it much.
But this is a new one.
What's that?
Yeah, this is my generation.
Yeah.
Anything more you want to talk about how price action reflects on the fundamentals?
Well, yes. I mean, as a technical analyst, and there's short-term. I mean, there's people that are going to trade the market based on technical analysis on a day-to-day basis. That's really not what this is. However, the decisions on which stocks to buy are based on price performance looking back over 4 or 5 years. So there's something in the price performance of a stock that reflects on how the company actually fundamentally is performing. So this is like backing into good fundamental companies by looking at their stock performance over a long period of time.
Mm-hmm.
So, like for instance, when we run these kind of simulations, and you look at the companies that emerge, fundamentally they're good, they're really strong, and they're steady, and it's the nature of the software. Now, I'm not the developer of the software. That is Scott Frank, who joined our firm within the last couple of years, and a friend of his. So this is, to me, it's like bringing fundamental and technical analysis together. But the technical analysis, meaning the price action of the stocks, looking back, is what is the determinator of what goes into the portfolio. And again, 500, S&P 100, we're not going far out of bounds here. And again, I said it could be applied to any ETF, anything with a portfolio of stocks. We can make these decision-making processes.
So it's any publicly traded, because that has data. It wouldn't be privately traded.
No, there's nothing privately traded. It has to have a daily price.
Mm-hmm.
It has to be traded on public markets on a daily basis.
Interesting.
Can I just sort of make a little segue here? Since you're both very experienced financial advisors, there's still a lot of talk about annuities and stuff. And I'm sure you have clients that say, well, shouldn't I put some of my money into annuities? What do you tell your clients?
Dave, what do you say?
What do I say? I mean, we have clients that have annuities, and it's one of those things. I think you have to understand what the product does and how it fits into your overall financial plan, and see if it's doing what it's supposed to do. And I guess the other comment I would say also is life changes. So clients that may have bought annuities in the past, there may be a different need. There may or may not be a need for that product today. So I don't think it's something that you just buy it and you forget about it. It's something that, just like any other part of your financial plan, needs to be monitored and reviewed on an ongoing basis.
Are the annuities you're referring to like single premium annuities or annuities?
I don't know. I just read about it and I hear advertisements for it, and people talk about it. And rave about it, and other people say, "Oh, they're awful," and all that kind of stuff.
Yeah, well, we have differences. I mean, there's a lot of differences of opinions about annuities. I know there's a major investment advisory firm that would their warnings are never invest in an annuity, and they're terrible. Other people say they're the best thing in sliced bread, and it's you could have a crash-proof retirement because maybe it's all annuities because they can't go down. And what I know about annuities, and I used to be insurance licensed, but I'm not now, is that the money coming out of an annuity is either your own money coming back to you, or it's the earnings that were created in the annuity, which is taxed at ordinary income tax rates, which is not as good as dividend or capital gains treatment. So, but if somebody wants steady income in retirement and they want to rely on it, then there's a place for them. So are we answering the question, Paul?
That's part of it. The other part of it, and I'm asking for, I guess, frankness, objective. You guys have seen it all for 20, 30 years, I think. The cost of annuities. I mean, I hear, people push these things because they're making their commissions are enormous, and they say it's not transparent, and they make no fees on it. Somehow they go to the Bahamas twice a year.
So I think we got like about a minute left. So, Dave, is there anything else you want to share with our audience here?
No, I mean, I think it's been a great conversation. I was listening to what you guys were talking about earlier, and I thought there was some great advice about some of the tax laws that have changed and what you can do with your IRAs, and that people should be aware of those things. And I guess one thing I would say, and I make this quick, that if you have something that earns ordinary income, that should go into an IRA, because the IRA is going to come out as ordinary income regardless of what is in there. And if you and then outside of the IRA, I'd put the things with dividend income or capital gains, just a general sort of rule.
That sounds good.
Okay, great. Well, thank you very much, guys. Appreciate the perspective. That's sort of the technology aspect always is fascinating, and glad to learn a lot about that. And we have to wrap up our show, but I just want to add that our next guest will be Doug Hepburn, CPA and CFP, Hepburn Financial Advisors, and I think he can tell you a little bit more about what those acronyms mean at that time. So we'll close the show. I just want to thank you for viewing, and remind you that, remember, on this show, your money matters.